Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into today's episode of the Money Insights Podcast. I'm your host, Christian Allen. With me, as always, Rod the Pod Zabriskie. Rod, what's up, man?
Hey, I'm doing great. But what I want to know is, how is Christian the Answer Allen doing?
Hey, well, that was just your way of like teeing me up, because last time I was like, what if I use this? Well, newsflash, Rod, I'm not using it ever, never. But I'm glad you can call me it if you want.
Yeah, I mean, I figured if I didn't, nobody would, because I'm the only other one here, and you're not just going to keep doing it yourself. So
that's true. I mean, we might get a couple of emails and that kind of thing. But I guess it does make sense. Like, you don't go around calling yourself the Pod either, right?
Nope, I haven't.
Okay. No. Well, probably a good idea to stick with that. Hey, Rod, let's talk about private credit. So here's the deal. Private credit is a big thing. Big thing right now in general. It's become bigger and bigger over the last, year or so, to the point where I feel like it's the hot button topic. In fact, it was interesting, Rod. I remember this was just a few weeks back. I was bringing it up to the team in a meeting in the morning, and then we got on with Tate a couple hours later, and he introduced his private credit fund. So good timing. Anyway, point is, private credit is a big thing. And of course, our job is to help educate so that people can make good decisions about these types of things. So we're going to break it down. What is private credit? What are the good? What are the bad? What are the things we need to be thinking about? And how Rod and I feel about it. So the question is, Rod, is it the next big home run, or is it the next big bubble, or somewhere in between?
We're going to answer all these questions.
I know. We're just like we're really putting them out there, aren't we? Okay. So the obvious starting point, Rod, is we've got to describe what private credit actually is in a nutshell so that we can dive deeper into it. So why don't you kick us off with a little summary?
Yeah, so private credit is loans made primarily to companies, mid-sized companies, the kind of company that maybe as they were growing, they were getting loans from their local bank or regional bank or something. But maybe they outgrew the bank's, like, not interested in the size of loans that they're looking for anymore, but they're not so big. They're going to go out and issue a bond. So they're kind of in this middle ground.
So you're saying it's not a bank loan, but it's not a bond. It's oftentimes significant amount of money, but it's from regular people, right?
Yep.
So
non-traditional lender.
Yeah, any non-traditional lender. And by the way, so I should be clear, the business. So actually, why don't you lay out like an A+B=C scenario where you're clearly delineating the company, the investor, and
the lender that's in between.
The lender in between. Thank you.
Yep.
Okay, break it down for us, Rod. Give us an example of what this would look like if I was investing in the private credit world.
Yeah, so let's start with the company that's taking the loan. Okay, that needs the money, right?
Company ABC.
Yep,
That's
ABC
really
company. They need $50 million, right? They've grown. They're now a $250 million company, but they need capital. They're continuing to grow. They need to feed that growth.
Okay, let's call it Goliath National Bank. Yeah, they're a bank.
Goliath.
Except there go Goliath National Bank. They're going to, and I got that from a show. I think it's from How I Met Your Mother. I think that's where Barney works. Anyway, Goliath National Bank, they need a big old loan, and they're like, I can't get it from the banks, so where do I go?
Yeah. So they're put in touch with a group, a private credit
Usually
firm.
A fund. Yes.
Fund. Yep, a fund. And the fund, over the previous years, has been creating relationships with individual investors who want to put their money somewhere where they can get a decent return, fairly predictable, cash flow, that kind of thing. And so they have hundreds, 200 to 300 accredited investors that have invested in their fund, and then they turn around and they make this loan to GNB, Goliath National Bank.
GNB, Goliath National Bank. Okay, so everybody wins. Goliath National Bank now has gotten the capital that they need to grow their business, right? And the investor, the debt fund has now gathered investor money and invested. They've taken their middleman, whatever their fees are that they take, and probably a combination of returns and just like regular fees, right?
Yeah.
And ideally, the investor has gotten a solid, consistent return as that's gone along. Everybody wins, right?
Yeah,
at least that's the idea.
I think so. Yeah, right.
Okay. Well, I hope that works because there's a lot of people doing the private credit thing. So fingers crossed, right?
And now if we look at it from the standpoint of the investors in the fund, we were giving Goliath as the one example. That's one loan that fund is making, but they'll have many other people or companies or real estate portfolios, or like it can obviously go beyond just like a company level, but they're making loans to a variety of different places.
Yeah. I mean, at the end of the day, when we say private credit, it is just what it sounds like, right? It's credit. Instead of getting it from a bank, you're getting it privately, AKA not a bank.
Yep.
And so that can, look a lot of different ways, but at the end of the day, that's the end result. Okay. So Rod, here's the big question for you. Why is private credit so hot right now? Why have we seen it popping up all over the place? And maybe more recently, it's like I've seen it creeping into real estate because I've been, paying attention to it, but it's been more and more real estate, or we've seen more of it in this like alternative real estate space recently. What's your take?
Yeah, well, I think we just need to go back. Well, let's go back 5 years. Okay. So COVID is happening. But real estate has been really hot for a couple of years leading into this.
A couple, Rod? I would argue it's been hot for like 10
decades
into this. Yeah. Probably for most of your 2010 to 20, it was pretty strong. Yeah.
So, but I guess what I was thinking of was just like values seemed to really go up during and right after COVID, or kind of 2021, kind of that time.
Yeah, there was another bubble where it like got really bonkers,
which obviously led to inflation and other issues that then interest rates rose. And as an investor in real estate, let's say it's real estate syndications, I'm going to pick on especially multifamily because we saw that category was just enormous. But it would have hit other categories as well. So people who were investing in those things and all of a sudden saw all this turmoil and volatility and capital calls and different things happening in where they've been investing, they're starting to look for more safe haven types of stuff. And the way that I've heard people describe it, they're like, I got enamored by the idea that I could go get 20, 30+% returns. My money comes back to me in 2 to 3 years. Everything was looking amazing. And except that all of a sudden it was no longer looking amazing. No longer was performing the way it had been. And so they're saying, okay, well, maybe I'm okay not getting the 20 to 30% returns. I'm using air quotes because in a lot of cases it didn't turn out to be that. I'm okay picking something that is, let's just call it boring,
more
right?
Stable.
Like debt, stable, not expecting as much of a return, but I'm okay with that now because I've just gone through a really rough time and I'm kind of licking my wounds, trying to find somewhere where I can have stability.
Okay. So you're saying, and this makes sense. Just like the equity market is typically more volatile than the debt market, than the what's the word I'm looking for? Bond market. That works. Fixed income market, all of those. Okay. So just like that exists, the same type of thing is existing in private credit, right? So private equity has higher upside. It also has more volatility because the terms, there's more variability or volatility in the terms and how those will play out. Whereas here, you're ultimately there's a deal that's being made based on how is this money going to be borrowed and paid back. And then we just have to place the investors into that. And basically the investors are going to get their portion, and then they're going to kind of create that carve out for the facilitator, which is the fund in this case. You know what I mean? So anyway, that's kind of an interesting dynamic. So is there any other reasons that you think it's cranking hot right now? Anything else that comes to mind that we didn't touch on?
Well, part of it is that banks have tightened their lending.
Yeah.
Beginning COVID.
Well, higher interest rates too. That's a big one.
Yep. That becomes prohibitive. So more companies, again, real estate portfolios, whatever, are looking for non-traditional lenders to help, so they can still carry forward with what they're trying to accomplish, but they can't get it from the bank.
Okay. So let's move to, well, we're going to call it the case for private credit, but let's talk about it from an investor perspective specifically. Right. Okay. So I'm going into it now. We got to throw out Goliath National Bank. Well, I guess we can still use GNC Bank. Like, we'll just roll with it. Okay. So we've got Goliath National Bank. And now Christian is like, hey, I want to get involved in this. In fact, I think I want to let Goliath National Bank borrow some of my money. Okay. So then I put my money in the fund, because I'm not going to give it directly to Goliath National Bank. Yep. So now I have my money in the fund. What are the benefits, or what are the reasons that I would want to do that as an investor? And maybe again, what are I guess benefits is the right word, but what's the outcome that we're looking for as investors?
Yeah. So each fund is going to have maybe its own defined flavor. So, when you look at this fund, that they're looking to lend to companies like Goliath. You may not know that they're investing to Goliath or lending to Goliath, right?
Typically you won't know who those are. Yeah. And that is we're going to talk about the downsides, but one of the downsides is there's not typically that much transparency to the point where you're like, hey, I know exactly which actual deals I'm involved with. You'll just know that there is a fund that is doing many deals with many different companies, organizations, real estate, all that kind of stuff.
Yep. But they're going to have the types of loans that they're looking for, and you'll have at least a feeling for what those are. Right.
Yeah.
And so therefore, as the investor, you'll have a good idea for what you can expect in terms of cash flow. It usually is going to be pretty steady cash flow, because the borrowers are making regular payments on that loan, right? With interest earned and other fees and other things like that are coming in. That's going to pass along to the investors on a pretty consistent basis. It may fluctuate somewhat, but it's going to be pretty consistent.
And at the same time, it's going to be higher than like what you can get at a bank, right? So it's this combination of like, hey, I'm generating a higher return than I would at the bank because there's a premium for private credit. So it ends up, okay. So steady cash flow is a big one. What else do I get out of private credit? Like that's a big one. I'm not trying to like put up my nose at that, because that's an absolutely big deal. And you think about it when you connect it with things like the investment optimizer, it just works so well, right? Because you're like, hey, I'm going to pay 5% interest on my loan. My policy is going to be collateralized against it, or my cash is going to be collateralized against it. And now I'm investing this money in something like this private credit deal where, let's say I get 10% or 8% or 12%, right? Somewhere in that range. But the nice thing is I just know I'm creating a positive, consistent arbitrage, which of course inflates the overall value of everything that's involved with it. So again, not putting my nose up at steady cash flow, but I just want to make sure, so tax benefits, Rod, that's one of them that I think about. As far as I understand it, there's no tax benefits to the private credit space. Is that where you're at too on that?
Yes, you're receiving that cash flow, and that's just going to be taxable. There are no bonus depreciation or other things like that.
None of that kind of stuff. Nope, not on debt. Not on debt. Okay. So a lot of times, like you said, it produces steady cash flow. It's typically collateralized against a business, real estate, something like that. And obviously that makes me feel a little bit better if I have some backing behind it where, you know, I know that there's some intrinsic underlying value that I can count on. And especially if you're in the real estate space, like that hard asset is going to be the primary backer. A little bit different in a debt situation or in a business situation, but
potentially, but it depends on why Goliath is trying to grow. If it's inventory or equipment or things like that, then likely there will be something like that involved.
Yeah, there could still be some type of collateral. And then of course, one of the other benefits, Rod, is that you're not investing in the traditional market. So now you're getting some money that's not exposed to the exact same types of risks that I would have if I was investing in primarily stocks, bonds, mutual funds, which I always say that, Rod, and it's usually just mutual funds. I always add stocks and bonds in there, but most of the time people are just in mutual funds. And this ends up being a really good, non-correlated asset to some of those types of things, whether that's in a qualified plan or whether it's in a brokerage account. It still ends up being another asset that's doing something different. And just by doing that alone, it can be really impactful.
Awesome.
Okay.
And can I add one more? And that is that in the vein of this kind of consistent whatever, it can be a good bond alternative for just kind of that consistent, like, again, like I mentioned earlier, a lot of people now are not only okay with, but looking for something that's a little more steady, maybe less upside, and they're okay with that.
Yeah. And I think there's a lot of power in that, right? So again, consistency, we always talk about how the downs hurt more than the ups help. Consistency upward is like really critical. Having those big downs can be really hard. And of course, in the private credit space, now you're still, money is at risk. And yet, especially if it's collateralized, it's relatively safe from an investment perspective. Okay. All right. So we've talked about what it looks like from, we've kind of talked about the structure of what this actually looks like. We've talked about what are some of the benefits to the investor. Let's talk about the case against private credit. So where do we start when we're trying to pick it apart and say, hey, here are the things that we ought to just be considering before we go and actually start putting our money in?
Yeah. Well, maybe I'll begin by comparing it to some of the things that went wrong in the 2022-23 rising interest rate environment. And that is that we talked about this big deal about, oh, it's collateralized. And yet, as we know, and as a lot of us painfully found out, collateral doesn't necessarily mean safe or secured, right?
Yes.
So depending on what it is, how it was valued when it was posted as collateral, et cetera, and how its value can change, that could potentially, again, we're not saying it is or it would be, but you just have to be aware that it could potentially not be quite as safe as we're thinking if we're just saying, hey, collateral, hard asset.
Yeah, that's a great point. So if I was to choose from, at least if I was looking for my safe deal, I would choose collateralized over not collateralized.
Yes.
But what you're saying is that not all collateral is created equal and even like valued equally, right? There's a lot of different factors that go into that. And again, if you compare it to the things that we've seen, like obviously there was a lot of value in these underlying properties that ended up not being able to, there was no, they couldn't get it out because of the interest rate hikes and things like that. So that exists. But I do think when we're talking about like a syndication that's private credit, it's still probably as a whole, not on any individual deal, but probably as a whole would be classified as safer than, again, an equity syndication deal.
Yeah, because the primary reason is that you're in first position. The reason why those properties, some of them, even though, again, it's a hard asset, but some of them basically value changed, interest rates changed. All of a sudden, the lender gets their stuff first before the individual investor got theirs, right? Yep. So now if you flip around and you say, well, what if you're the lender and you get yours first before the business, the Goliaths and other, whoever the borrowers are, get theirs? Well, now you're in a better position, hopefully, right? More secure position than what this other was.
Okay. So it's not always secured. What are some of the other things we need to be at least considering or thinking about before we go and invest in private credit?
Well, it's non-traditional lending. And so now we get to the operator level where how are they underwriting it? What are they looking for, et cetera? And as the individual investor, you're not involved in that process. You don't see it. You don't necessarily even know who they're lending to, what the terms were. All you know is what the positive cash flow was that's coming back to you on the back end. Right.
Yeah. Yeah. So that's an interesting element. And certainly you have to be aware going in that you're relying on, just like any other, I mean, obviously syndications have been such a big deal over the last probably 10 years. And so we've all learned that one of the critical elements, or maybe the critical element, is understanding the operator, their track record, and competencies, those types of things, ends up being the most critical issue. Like, it just is, because all of these other factors are being maneuvered, right? They're being controlled by that person or those people. So to your point, just like any other investment, we've got to understand the person or people who are actually offering it, and make sure that they have the track record that makes us feel comfortable putting our money into it.
Yep.
Okay. What's next, Rod?
Okay. So we talked about this a minute ago, but it's opaque in the sense that
I just like the word opaque, Rod.
That's great.
We definitely don't want opaqueness. No opacity. Okay, that didn't work.
I think it's opacity, but anyway.
Okay.
Yeah, exactly.
Yeah. Nothing opaque is good. That's all I'm saying.
Right. And yet there it is, right? Like
there
you're making your investment, trusting the operator. Again, that's why you're putting so much trust and faith in the operator, because you don't see it as it's happening.
Yep. You don't know the borrowers. You have to believe in the people that you're working with. And then another one, Rod, it's illiquid. That's an issue, or it can be an issue, right? Now, I say it's an issue. It's an issue if I don't plan for it appropriately. Just like always, just like any other investment, we have to be thinking about the entire picture, not just the one spot. So it feels silly to even say out loud, but if I've got $100,000 to invest and that's the sum of my number, I probably don't want to put all of that money into private credit where it's going to be locked up for a few years, or whatever the time frame is based on the parameters of the deal.
Yeah, and I've seen some where they're creating set time frames. There will be a liquidity opportunity at this certain set times. Yep. Or I've seen them where they say, give us 90 days or 180 days or something. So you put the request in, but you're not going to get that money right away. You're going to have to wait until because they have to get another investment into your place.
Okay.
Right?
That's a good point. So you're saying, you're just saying, hey, we don't want to be unfair to it. It is possible to get to liquidity can exist in it, but it's not as simple as, hey, they're just going to immediately say, oh, great, here's the money. To your point.
Yeah.
They would put a new investor in that place. And once they raise that capital, then they might be more capable of making that liquidity event happen for you.
Yeah. But you want to know going in what that is, because they're going to define that, right?
Absolutely.
They're going to have those parameters set.
Okay. So I think those are probably, is there anything else you want to talk about as far as like things that I ought to be thinking about? I said the case against, but I don't know that it's the case against. It's really just an understanding of what are the benefits that I get from using private credit versus what are the risks that I'm taking on and the things I need to think about. One of the things that helped me, Rod, as I was kind of going through and trying to understand the dynamics of private credit, and this has been a little while. I've gone through a few different phases. As it started to get hot, I started to spend a little bit more time on it. And then, of course, coming back to it to talk about it more today, it dawned on me like a really simple way to think of it is kind of like hard money lending, right? Because just in that same way, it's people who are going outside of the traditional bank to get their money, get their financing. And what that then creates is an opportunity for investors to take advantage of it. People who need money in short-term loans. Now, there's some obvious differences, right? The big difference is that hard money lending has to be backed by a hard asset, whereas private credit does not necessarily have to be backed by a hard asset. It could be well, it doesn't have to be backed by, it could be good, the faith of a company, right?
Mm-hmm.
So anyway, that's the big difference. But in my head, I was like, okay, this is pretty simple. It's really just ways for us to look outside of a bank to get money. And again, from my perspective, I think it's a great a great opportunity for people to take advantage of a need that's just naturally crept up and that exists inside the marketplace, right? So there has become a wider range, from my understanding, a wider range of situations where the banks don't want any part in the lending.
Mm-hmm.
And so again, what that does is it creates this really unique or kind of intriguing opportunity for investors. And of course, innovative investors decided, guess what? We're gonna take advantage of it. We're gonna take that opportunity. And so the biggest issue, again, keep saying it, but the biggest issue is just finding the right people to do it with. It's probably less about whether the investment itself is good, because the concept, I feel confident, I feel comfortable, is pretty solid. It's
Mm-hmm.
really about those other elements that, make us determine whether it's actually a good investment for us. But I have one thought, Rod, and then I'll let you take a minute to kind of give me your thoughts. And I may have said this. Maybe I did. I think I said it already, but it works perfectly with the investment optimizer. I did say that, but I couldn't emphasize it enough, because I feel like oftentimes when we're talking about using a policy to invest through, people struggle a little bit with not knowing the outcome of the investment itself, right?
Yeah.
So it's like, okay, I like the idea of doing it and I feel like it can work. But sometimes it's hard, right? Like, you think about a situation where let's say I put money into my policy and then I put it into a real estate syndication that may not have like a major liquidity event for 3 to 5 years or something like that.
Yeah.
Right. And so in those situations, it becomes it can be harder for people to get their head around. I guess what I'm really saying is this is an easy way to get started using your policy, because you know exactly what you're getting on the back end. There's not a question, you're not suddenly going to get some influx or not. You're just going to get a consistent monthly or quarterly check that you can then go and, push back into your policy and then do it again, like we always talk about. So anyway, those are some of my kind of thoughts on, where private credit is. And I will certainly use private credit myself. I keep saying this. I still keep breaking it. So Rod, I'm obviously building my house. Everyone who's listening to this knows I'm still building. Feels like it's been 6 years since I started building this house. We're getting a little bit closer every day. Tiny bit closer.
Yeah.
But one of the most frustrating things is that I have to hold on to liquid cash, and it just eats at my soul, Rod. It eats. So anyway, but my point is, once I'm done having to worry about that stuff, then I will absolutely put private credit deals into my repertoire of opportunities that I'm interested in and would invest in. So anyway, those are some of my thoughts on private credit. What's your take, Rod?
Yeah. So earlier when I was kind of setting the stage for why I feel like it's become more hot, more in demand, I was pitting it against the other side of people investing in real estate syndications or things like that. And in reality, I think for level-headed investor, that even if they had losses, they can look and see, hey, there are still going to be opportunities to invest in real estate. I know where
this is going, Rod. I can feel it. Keep going.
It becomes part of that diversified portfolio.
Diversification. I knew Rod was going to take us there.
Of consistent, steady, predictable cash flow coming in on the one hand, and maybe less consistent or less predictable, or it takes time, right? You invest in something that needs some sort of build out, and it's going to take 9 months to do that. So you're not going to have cash flow right away. It's going to be delayed. And all of that works out really well. Again, going back to the investment optimizer, it's okay to invest in things that aren't necessarily consistently cash flowing and helping you cover the interest and paying down the loan, et cetera, in some of your investments, especially if you do have other places where you are getting that. You have that consistency. It's just flowing. It can help give you that steady flow going in, and working together, giving you an opportunity to potentially get higher returns, have higher liquidity events, et cetera, and investing in places where you have that consistency.
Can I get one other tip, Rod, before we
Please
sign
do.
out for today. My tip is this. If you're going to get involved in the private credit space, I would probably try to avoid the mass market deals that are just being pushed out to anybody and everybody, and look for the people that you're connected with. Obviously, we talk about doing business with people we know, like, and trust. And sometimes we confuse size with trust. And just because something's being pushed out there to kind of everybody doesn't necessarily make it a good deal. So just be thoughtful when you're getting into this space, because it's been flooded. Unfortunately, there's going to be both good characters and bad. And so we have to be just kind of thoughtful watching that, make sure that we have our antennas up, ready to spot a bad deal. Go back a few episodes and remind yourself how to spot a bad deal. Okay, well, Rod, I think you are 100% right, and I'm just proud that I was able to count on you to bring in diversification, Rod. Diversification.
You can count on me.
You can count on you. Okay, thanks everybody for listening. We'll be back next week. We're going to talk about whether or not it's becoming more difficult than ever before to build wealth, and particularly to build generational wealth. So we'll see you then.
Thank you for listening to the Money Insights Podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights Podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.